let me then start by saying that Costa Rica is right now going through a difficult international context, as every country in the world. In our case, it is not just about the global economic slowdown and the trade and financial tensions that we're seeing in the world. It is also about some regional shocks. And in particular, for the case of Costa Rica, the situation in Nicaragua has been particularly important. There is a deep recession going on in Nicaragua, along with social and political problems, and that has created an issue for our exports to Nicaragua and to the rest of Central America, as most of our exports to the rest of Central America go by land through Nicaraguan territory. And so that has become an issue for us beyond mere exports to Nicaragua. Of course, there's also contagion from Nicaragua to other countries, and in that regard, there is kind of a second round effect on Costa Rican exports. Also, in addition to the external shocks, if we may call them like that, there have been climate shocks. And in particular, we have this year El Niño with us, and El Niño has been very severe. And it's created drought conditions in areas of the country that typically are not dry, and that has affected a lot of crops and therefore the agricultural sector, including some very important agricultural products that have been affected by this, like banana. And the external conditions have also implied that some of the agricultural export products have faced low prices, like coffee, pineapples, and so this has combined into a series of negative shocks. And in addition, we've faced in the last 2 years a situation of eroding confidence. And that has been essentially as a result of the perception and reality of fiscal problems, but in particular the perception that the fiscal situation was unsustainable led to a loss of confidence, both by consumers and investors, and that implied also a retrenchment in consumption and investment. And that has implied, that has led to a marked deceleration in economic activity. So this is the result of both the external factors, like climatic shocks, and the domestic uncertainty regarding the fiscal situation, which led to, as I mentioned, let me see if I can move this, to a very marked deceleration in economic activity. This is the monthly index of economic activity, and as you can see, it's been coming down systematically, and this is January 2017. In fact, if we look back, the deceleration starts around 2015, but it reaches really low levels of economic activity around May. And now we're seeing kind of green shoots of a bounce back, but it's too early to tell. And having been at the IMF, I know that we cannot just claim victory by just a few observations of economic recovery, but certainly this gives us confidence. When you look at the acceleration, not just the year-on-year variation rates, you see that there is a strong bounce back in terms of the momentum of economic growth. And some activities are doing better than others. When you look at the composition of growth, you see that some industries are really driving the deceleration. Construction, which tends to be very volatile, only last year was growing at very fast rate. This year it is decelerating very fast. But also agriculture has been impacted by the negative shocks, as I mentioned. Nicaragua has been also a factor for agriculture, not just the climatic shocks, because some of agricultural exports go to Nicaragua. And manufacturing has actually not done so badly, but when you decompose manufacturing into the free trade zone activity and the rest, you see that free trade zones are growing at double-digit rates, whereas domestically oriented or Central America-oriented manufacturers are not doing very well. In fact, they are contracting. And also wholesale and retail trade are not doing very well. I'm sorry. So this has led to an increase in the unemployment rate as well. And I think this is important because it's created a gap between what we consider the equilibrium rate of unemployment and the actual rate of unemployment. So between that and deceleration, we have economic slack in the economy right now. Now, as I mentioned, at least within the domestic realm, one of the key factors has been the fiscal. And before 2018, certainly there was a lot of uncertainty regarding the sustainability of the public finances. There was a reform in 2018, however, in December 2018 that was approved, and this has completely changed the picture. This was not the presentation I meant to give you. I'm sorry. This is a full presentation, which has like 60 slides. So I'll have to basically just skip, I think. But you can see this in this chart that you have basically an increasing fiscal deficit. Forget about the public sector. I'm looking at the central government here. Is the dark blue line? An increasing fiscal deficit for the government, and also an increasing primary deficit. Now, in 2019, you can see already that there is a deceleration in the primary. In fact, it started already in 2018 with administrative measures that were taken by the Minister of Finance to try and stem the growth in expenditure. But this is already kind of reflecting more clearly in the 2019 numbers. Up to September, in the year to September, we see already quite a significant reduction in the primary deficit to GDP ratio. And that is important because it leads to what I was meaning to show you here, which is basically an inflection point in the debt to GDP ratio, which in the course of 2 or 3 years will reach a high of around 68% and then start declining. And that is driven essentially by the fact that the primary balance it's turning into a surplus as a result of the fiscal reform. Now, the key question is, so what is this fiscal reform that was approved in December 2018? Well, it's a comprehensive, balanced reform that contains revenue measures and expenditure measures. On the revenue side, there are two main sets of measures. One is the introduction of a VAT, of a value-added tax, which essentially is in terms of collections, it is the extension of the existing sales tax into the services sector, which were not subject to the sales tax. Other than that, it has some technical changes that make the previous sales tax a proper VAT. It was kind of a VAT, but it required a system of credits that was not the financial credits that are typical of a proper VAT system. So this is introducing a proper VAT system and extending or expanding the applicability of the previous sales tax or imperfect VAT to the service sector. And in addition to that, there is a set of income tax measures, including the introduction of new income tax brackets on personal income. The second set of measures is on the expenditure side. And that is, I think, the crux of this fiscal reform, because the fiscal reform hinges on making sure that we have control over the fiscal finances over the long term. And that requires really placing a lid on the growth of expenditure. If you just try to do a fiscal adjustment on the revenue side and you don't control the expenditure side, very quickly you will find that you will have to keep coming back to Congress for more tax measures. And that is the experience in emerging markets. The only way to really tackle sustainably a structural fiscal deficit is to control expenditure. And so this is, I think, the most important part of the revenue, of the fiscal reforms passed in December, that it contains a number of expenditure measures, and in particular, it's underpinned by a fiscal rule. And that fiscal rule is kind of seen as a high-quality fiscal rule or second-generation fiscal rule in that it is based on the containment of current expenditure. So basically, it has a number of parameters that determine how fast current expenditure can grow as a share of GDP, and that is based on the level of the debt or the ratio of the debt to GDP, and that is kind of the thresholds on which the rate of growth of current expenditures are based. So that basically puts a ceiling on the growth of current expenditure, but fiscal rules across the world have been violated, and it's very frequently the case that fiscal rules, even though they are there on paper, cannot be abided by. And the reason is that you need to give them content. And so I think the most important part of this expenditure control measures is that it gives teeth to the fiscal rule. How? Basically, it controls two of the sources of uncontrollable growth in expenditure. One is remunerations, public sector payroll, and it introduces a number of reforms on public sector pay schemes, and in particular, the elimination or containment of incentive mechanisms. And the second is that it reduces or eliminates earmarked spending. So those two, the payroll schemes and the earmark spending had become sources of rigidity in the budget that made it very difficult to actually tackle expenditure. So this fiscal reform is not only creating this fiscal rule, but also giving it the ability to be met, to be complied with. And so we are very confident that this is going to lead to precisely that path of primary balance that will then contain the growth in the overall fiscal balance that, as you can see, will remain slightly high. I mean, it will remain high, above 5%, almost close to 6%, because of the weight of the interest expenditure. But certainly the primary expenditure, the primary balance, which excludes interest, will continue to improve very significantly until 2023 and become a fiscal surplus, a primary surplus. And that will allow us to have that inflection point in the debt to GDP ratio. So of the two sets of reforms, the revenue side and the expenditure side, we estimate that around 2/3 of the total yield of around 4% of GDP from this reform will come from the expenditure side. And the other third will be on the revenue side. So I think really this is a high quality reform, but the drawback of this is that in order to see that containment in expenditure, you need time, because in Costa Rica it is not possible to cut nominal wages, and it is also not possible to completely cut social assistance programs. So the only way to do this in a reasonable, constitutional, consistent manner is to contain growth in expenditure, but not to cut actual expenditures. And so when you contain the rate of growth, what you will find is that the share of expenditures to GDP will fall over time, but it will take time for that dynamics to happen. And that's what you're seeing. It takes a while for the primary balance to become a primary surplus, but that is a lot more sustainable than just relying on new taxes to be able to address an unsustainable fiscal situation. So after the passage of the fiscal reform in December 2018, what we saw was a rapid stabilization of financial markets. In the last quarter of 2018, we had a lot of pressure on financial markets when really the uncertainty around the sustainability of the fiscal finances and whether the fiscal reform was going to be passed by Congress or not came to a head. And so we saw strong pressures on the exchange rate. We saw strong pressures on the interest rates. The government started struggling to finance itself. It was financing itself at the very short end of the yield curve, and also at very high rates. And once the reform was passed, the situation normalized very quickly. So the government, particularly after February, March, started being able to get much lower interest rates and at much longer maturities than it had before. So it's basically displaced along the yield curve, or moved along the yield curve, but more importantly, with the yield curve also shifting down significantly between 200 and 300 basis points. And that has been very critical in terms of creating kind of a self-fulfilling confidence effect in the sustainability of the public finances. Now, the key, of course, here is implementation. And there have been the credit rating agencies were worried about the many implementation risks that they saw from this type of fiscal reform, where a lot hinges on the expenditure side. So last year, right after the fiscal reform was passed, they downgraded Costa Rica by 3 notches. Basically, pointing at what they saw as key implementation risks. Now, this year has been a good year in terms of consolidating the commitment of the government to the implementation of this fiscal reform, and I think that has led to precisely those good results in terms of a reduction in interest rates. Now, let me move now to monetary policy. We've seen that fortunately inflation expectations, let me see if, oh, maybe this was the right presentation. Yeah, it is the right presentation. The inflation rate has been coming down in Costa Rica very dramatically since 2018. You can see here the headline inflation rate coming down from double-digit rates to kind of moderate rates of around 4 or 5% to then actually deflation around 2015 and moderate, very low moderate inflation just around the lower end of the inflation target range of the central bank, which is 2 to 4%. So it's been around 2% for the last 2 or 3 years. And more importantly, inflation expectations have come down as well and now converged to the midpoint of the inflation target range, which is a vote of confidence from basically economic agents that the central bank will continue to abide by its commitment to keep inflation, the forecast inflation, within the target range. Of course, we are what we technically call an inflation forecast targeting regime, in the sense that we target not just the inflation today, but we target the inflation 18 months ahead, as it should be, because there is a lag in the implementation of monetary policy, and in particular, there is, in the case of Costa Rica, a lag that is estimated between 12 and 24 months in monetary policy to actually affect economic activity and inflation. And so at any point in time, what you should do is actually move monetary policy to target the inflation that you forecast 18 months ahead, at least. And so that's what we're doing, but in this exercise, it is critical to have the inflation expectations, and these are inflation expectations 12 months ahead, anchored around your inflation target. And that anchoring of expectations has allowed us to engage in deliberate countercyclical monetary policy. So we've been at the central bank reducing the monetary policy rate from 5.25 at the beginning of the 25% at the beginning of the year to 3.75% right now, and that is basically as a result of that that monetary space that has been created by the anchoring of expectations. Along with that, we also reduced the reserve requirement in domestic currency, not in foreign currency, as a way of both complementing the monetary policy rates in relaxing monetary and financial conditions, but also as a way to discourage financial dollarization. And so going forward, monetary policy will remain committed to the inflation target, and we will continue to focus on our communications on making sure that inflation expectations remain anchored. Now, very quickly, let me turn to the financial sector. We've been implementing a number of wide-ranging reforms in the financial sector. Very critical here is the accession agenda to the OECD. As some of you may know, Costa Rica is in the process of becoming a member of the OECD, and that entails a very deep, wide-ranging set of structural reforms, and some of them have to do with the financial sector. So in the year to now, we have managed to pass a number of laws, including one to strengthen the autonomy of the central bank, another one to create a number of reforms that were critical, like changing the financing mechanism for the structure of supervision and regulation in the financial sector, protecting the supervisors, legal protection of supervisors, and rules on the exchange of information between superintendencies within Costa Rica and across borders, which is also a critical input to be able to sign the IOSCO memorandum, which is also a precondition to accede to the OECD. And also, just yesterday, we approved, or the Congress approved, consolidated supervision bill, which strengthens also supervision across the board and helps the country move towards Basel III, not just in terms of having proper consolidated supervision within and across borders, but also being able to move towards a more risk-based type of supervision. And finally, on the external sector, and this is really the key strength of Costa Rica, and this is where I like to see the glass half full, because despite all these external challenges that we were talking about, Costa Rica remains very strong on the external sector. exports of goods and services remain relatively strong, particularly those from free trade zones. And here I would like to emphasize the strength of the service exports. And it's not just tourism. We have now created a niche where Costa Rica has become very strong in exporting particular types of services, like initially it was call centers, then more back office type services, and now kind of high value added business support services in law, in consulting, in advertising and marketing, and of course the industry that has become a niche. We're kind of the Bangalore of Central America, which is software exports. And that's also very strong. And these exports have remained very strong. Some of these industries are growing at double digits. In addition to that, we have some of the manufacturing, the free trade zone manufacturing activities that have become kind of important for Costa Rica, electronics and medical devices, also doing very well. One would wonder what the situation would be like if the external context were not so difficult. So they are growing at double-digit rates despite the challenges of the external sector. I wouldn't think that the external sector is helping in any way. But this has helped, this strength has helped reduce the current account deficit, along, of course, also with the deceleration in imports as a result of the weak internal demand that has come from all the factors that I mentioned, in particular weak consumption and private investment, and that has also created a drag on imports. So these two things together have led to a reduction in the current account deficit. But we've already had a reduction in the current account deficit as a share of GDP for many years as a result of this booming export sector, the service export sector. And finally, FDI. We remain very strong in attracting FDI. FDI inflows as share of GDP have remained over 4%. They have narrowed a little bit, but they remain very strong. And I think these key strengths will be critical in making sure that Costa Rica bounces back and making sure that those green shoots that we are seeing, if propelled by returning confidence, which requires strict implementation of the fiscal reform, will then lead to a higher rate of growth. We estimate potential rate of growth in Costa Rica at 3.5. So clearly the Costa Rican economy is growing well below potential, and output gap is opening up, and we want that growth rate to get at least back to its potential, if not higher, and we have the pillars there for a higher growth rate. What we need is just the strict implementation of the fiscal reform, which given how it was structured, we're pretty confident it will be there in place, and that will help return confidence, not just in the financial markets, as we've seen already, but more importantly, in the real economy, consumption and private investment. So with that, I leave it. I think that was exactly the time. So I don't know if we have time
thank
for
you, Governor.
Q&A.
We don't have a lot of time, but if you do want to take one question, I'll ask you. It's not monetary policy, but I think it's a theme that matters a lot in the region. So someone asked, are there concerns in Costa Rica about migration from neighbors, the fiscal impact, what it all means for you and for the region?
Well, there is an increase. There has been an increase in migration. We've had strong migration in the last 5 or 6 decades, starting with the civil wars in the rest of Central America, particularly when the situation in Nicaragua worsened in the 70s. We got a lot of immigration in the early 80s as well. Also immigration from El Salvador, and now we're seeing again an influx of Nicaraguans, fleeing from the very difficult social and political conditions that the country is facing. So we're kind of used to dealing with immigration flows. Not to say that it's easy. It's an issue that, like in any country, generates social tensions. It generates some pressures on the fiscal. But also Nicaraguans come to help with a lot of sectors that Costa Ricans don't want to work in. And so, we have a lot of Nicaraguans working in seasonal agricultural industries, and that has been extremely helpful. Studies that have looked at the issue of immigration have concluded that immigrants are net contributors to growth and even the fiscal once you consider all the factors. So, I think it's an issue that needs to be managed carefully, and particularly the tensions that are generated socially, but economically on the net, it's a positive, and so we welcome the migrants.
Thank you, President. That was a very interesting intervention and very valued for us because we're very focused on frontier markets. Thank you very much for being here with us.
Thank you. Thank you very much.